the best day to invest was yesterday and the second best day is today. So most of us tend to overthink, I have a lakh of rupees, where do I put it, who do I talk to, what podcast do I watch, which YouTube video should I see, which expert should I listen to. I think that's great, but first do get there, start investing first. If you're uncomfortable, put it in a slightly lower risk instrument like a hybrid fund, which is nothing but a mixture of debt and equity. Start, and then as you get more confidence, go up and then keep putting money. Key thing is to start.
Hello everyone, I'm Bhartinder Singh. Welcome to the second edition of This or That. Today we have a very special guest, Raghav Iyengar, who has 30 years of experience in mutual fund industry. This is an unparalleled experience. He's currently CEO of 360 ONE Asset Management. Previously he was CEO of India Bulls Mutual Fund. He also held significant positions in different mutual funds. He was Executive Vice President of ICICI Prudential for over a decade. He was also Chief Business Officer for Axis Mutual Fund. So I welcome Mr. Raghav Iyengar for some very insightful session. Hello Raghav.
Hi, Martin.
Thank you very much for coming here, and welcome to the second episode of This or That.
Thank you, Martin. Happy to be here.
If it's okay, I would like you to comment on the budget more from the perspective of what is in there for the investors.
Obviously, the big headline is that there's been a big tax cut, especially for investors in taxpayers earning up to about 12 lakhs a year. Right? Earlier, the tax-free limit used to be 7, it's gone up to about 12 lakhs now. And there's a whole host of other things that has happened. What this is doing is hopefully will make people spend a little more money, because obviously you have less tax to pay, so you have that much more money to spend. My only point that I would like to make in this podcast, in this show, is that please save a little bit of that money. So if you got 100 rupees, I would call a tax gift from the government, please don't spend all that 100 bucks, try and put away 20-25 bucks today. And this specifically applies to people who are young, who are starting off.
So Raghav, you spent 30 years in the industry.
Yes,
I would like your perspective on what has changed, how industry has changed, and how investor behavior has changed over these years.
I think when I started, Bhartin, the investor behavior long term used to be 1 week, short term used to be a few hours. Obviously, thanks to things like what we are doing today, your podcast and other educative things that are happening in the world, I think that has dramatically changed. I think long term really means long term now. I think a lot of investors now are putting money on goals, right? For retirement, for house purchases, for something. And my time, investments used to be more trading oriented. Now they're actually investment oriented. Number two, I'm seeing a shift of money from traditional savings instruments, from where I used to start, to more capital market instruments today. SIPs, classic case, right? I mean, there was nothing like SIPs 30 years back. Today, the industry gets about 3 lakh crores a year, more than 3 lakh crores a year on SIPs from more than 2 crore plus investors, right? It's a big change. And I think the regulator has to be complimented for that, because I think they've created a beautiful ecosystem where people feel confident of putting money into capital market instruments, right? I think lastly, tolerance to risk is much better today. So there was a point of time where, if the market falls 1%, 2%, people would start panicking. Today I'm seeing diagrammatically opposite behavior. Actually, we have noticed that when market falls, our purchases go up, which is very, very different from what it used to be, say, not even maybe 2 decades back. So those are the 3 broad trends that I'm seeing today.
And industry, how you think has changed in terms of helping the investor?
No, it's much more transparent. I think today you can get a portfolio every month. I mean, I was quite surprised in some of the biggest financial markets, Bhartendra, you don't get your investment portfolio for 6 months. I mean, if you go and look at a fact sheet of anybody today, and if you look at the kind of information that is provided, say, in a mutual fund fact sheet in terms of companies, sectors, ratios, I think we are far more, possibly, I'm sure must be amongst the top decile in terms of transparency. I think cost, obviously, I think we run a reasonably tight ship as far as investment management fees are concerned, especially compared to some other developing markets, right? And I think that's a big shift that's happened. Number two, ease of onboarding is much better today. I mean, it's pretty much digital now. I could open a SIP account today while I'm talking to you on the show in 5 minutes, right? Which is maybe 10-15 years back used to involve a lot of paperwork. So all those things have become much easier. And the same thing works on the redemption too. I think when you take out money immediately, you get your money in your bank account within the stipulated time. There's very little follow-up, and I keep watching, for example, complaints, right? And for the kind of number of investors that we serve, for the number of transactions that happen, complaints are very, very, very extremely low. So that shows that there is a certain level of efficiency that's got built into the whole investment process, be it onboarding, redemptions, investments, transparency. The whole system is actually fantastic at this point of time. Yeah.
So if today somebody wants to start, somebody has 1 lakh rupees.
Okay.
And given his risk tolerance and given his context, and he's just starting the investment, how will you construct his mutual fund portfolio with 1 lakh rupees?
I would first ask him, how long does he need the money? I mean, if he says, so we have mutual fund schemes which can help you invest money for 1 day and can go as long as you want, right? I mean, there are retirement funds which allow you to park money for 20, 30 years if you want.
So if it's a long-term
view? It's obviously a long-term view, then obviously I think equities is a good place to be because equities has been proven that it tends to, you basically invest to try and beat inflation, right? Inflation is nothing but your value of money decreasing every year, right? And one way to avoid that or to sort of beat that is to try and put money into equities. Of course, equities are volatile, as we have seen especially in the last 5-6 months. It does go up and down. That's the nature of the investment. But over long periods of time, those ups and downs actually sort of get evened out a bit. So obviously, if someone has a long-term investment to play, I think you should put into equities, like say at least 15-20 years.
So within equity, any particular category?
Yeah, so today I think, I mean, obviously if your risk tolerance is pretty good and you can see, the whole idea is how would you feel, you should visualize this as an investor, because every investor is different, right? So if you sit back and think, hey, I put 1 lakh of rupees today, after 1 year, if that 1 lakh of rupees is 80,000 rupees, how would I feel? Obviously you won't feel great about it, but are you willing to be okay with it, or are you very, very worried about it? Now let's say you're very worried about it, then you should get into a hybrid fund. Right? If you're okay and you're saying, yeah, this is the nature of the animal, I'm okay, I don't need this money, then you should get into maybe slightly riskier funds, like maybe small cap or mid cap funds. So I think it's ultimately about how you personally feel about losing money. I think what has been proved in the last 15-20 years is that if you stay for a long period of time, the market or the equity markets do tend to reward you. But it's important to stay that period of time. And lastly, I would say, Bhartinder, don't overthink this decision. Do it quickly. The best day, there's a very famous man who said this, I think it was Warren Buffett, who said the best day to invest was yesterday and the second best day is today. So most of us tend to overthink, hey, I have 1 lakh of rupees, where do I put it, who do I talk to, what podcast do I watch, which YouTube video should I see, which expert should I listen to. I think that's great, but first do get there, start investing first, and if you're uncomfortable, put it in a slightly lower risk instrument like a hybrid fund, which is nothing but a mixture of debt and equity. Start, and then as you get more confidence, go up and then keep putting money. The key thing is to start.
So if somebody wants to start just with index fund,
no problem.
So what is your view? Like, what's the difference between passive funds
and active? Passive is nothing but you're replicating an index. As you know, an index is nothing but like the Nifty 50 is a list of 50 stocks. And your money will be placed pretty much in proportion to that number of stocks in the index, right? Whereas an active fund manager can go out of the index. He can buy different stocks, he can buy different proportions, and that's the basic difference, right? So if you just want to be in the market, index funds are very simple to understand. There's a Nifty 50, that's the top 50 market cap names, you put it in, that's one way of doing it. But I think my personal advice is that you put it in a mixture of both. You have to have a mixture of both. I am actually a big fan of actives because I think India is yet a developing economy. I think there's a lot of value that active fund management brings to the whole investment process, right? But it's not an or, it's an and. And that and is your level of comfort on allowing a human being to manage it or allowing a formula to manage it. So if you want a formula to manage it, then passives are the place to go. If you want a human being and a process and intelligence to manage it, then you should have some bit in actives. I am a believer in the latter. So my portfolio is pretty much tilted towards active funds, but everyone to his own. Is
there anything you think is misunderstood about active funds? People don't understand active funds.
No, I think when people give money to active funds, they I think their expectation is that irrespective of where the market goes, they will make money. Right? So if market falls 10%, and you are ultimately an investor in that market. An active fund manager is also in the same market. He's not playing in a different market. Right? It's not that there are 2-3 different markets, and the active fund manager has a different market, and everybody else is in a different market. It's the same equity market. It's the same set of stocks. So what an active fund manager can do is possibly try and beat the market for you, both on the way up and on the way down. I think the most misunderstood thing which I have heard my investors question me is that, hey, market fell 5%, but your active fund also fell 2%. We were expecting the manager to be plus 5%. That's not practical, because ultimately the fund manager is ultimately his job is to try and amplify your market return or reduce the market loss. I think, and if they do that consistently over a period of time, that fund manager or the fund management company is a great company.
So within active funds, at the current valuation of mid caps and small caps, what is your view? How should people evaluate it?
I think it's a question of time, Bhartendra. See, I think we go through these phases of cheap, expensive, right? The fact of life is that when markets are really cheap, we use an internal, small, very easy to understand formula in 361 asset management, right? We call it the price to book formula, right? It's very easy to understand. And most of the times, if you see over the last 20 years, the market has been between a price to book of 2 and 4, right? And 4 is expensive, 2 is obviously cheap. Example of 2 in the recent past would be the COVID crash, which happened say 5 years back, right? But hardly anybody put money in that time. Right. The previous example to that would be maybe the global financial crisis, which happened in 2009, right? But you had more investors leaving than investing. Money tends to come after you made money, right? That's the fact. So now you say mid caps, small caps, are they expensive? Of course they are. But I think, to my mind, 2025 is going to be an interesting year, because the headline numbers may seem expensive, but if you go down and you see the list of stocks, there are many stocks which have corrected significantly. So I think it's going to be more individual stock driven rather than just index driven, So if someone, again, now coming back to your question, if someone has time on his hands, say 10-year plus, 15-year plus kind of money, and they get very keen to put, yes, mid caps, small caps are a nice place to put money. So again, I will go back to that basic question I asked you, that, hey, what's your time horizon? If you're going to say my time horizon is 5 years, then I would be a little worried about you putting money in mid cap or small cap. But if you come and tell me that, hey, no, my time horizon is 15 years and I'm okay if we lose 20-30% of my capital in that 15-year journey, I say that, hey, mid small caps are the place for you to be here. Because intrinsically mid and small caps are what are today's large caps or once upon a time mid cap, small caps. And, nobody becomes a large cap straight away, like very rarely. Very few companies go straight to the top 50 market cap, right? They all were small cap, then they grew well, then they became mid, and then they became large. So obviously, if you're having that patience, and obviously through that journey, it will go up and down, and you can stand that journey, then you should be in mid and small cap.
So sir, long term is fine, okay, but then question that comes to me is, I'm okay with 10 years, but is there a period if the fund underperforms, I should exit? How long can I stay with the fund if fund is underperforming?
See, Bhartendra, this is a very interesting question, and frankly, we've not been able to crack it, right? I think there are different criteria which people use in their mind. One is obviously what I tend to do in my life is I try and see my asset allocation, and I try and look at that every 6 months, or whenever there's a sharp move either way. Market goes up, market goes down. Right? Your debt, equity, gold, essentially these are your 3, 4, 5 large assets that you own, right, in some format or the other. Now obviously, let's say markets have appreciated a lot, you need to take some money off the table. So obviously the first thing you like to see is, hey, what's not doing well in my portfolio so that I can take it off, right? Now I look at it very differently. I don't worry about the near term returns. By near term I mean 6 months, 9 months, 1 year. I am yet okay up to 3 years. Right, if a fund is underperforming for 3 years, but it's intrinsically a great fund, like let's say hypothetically from 2016 to almost 2020, value funds didn't do very well. Right? That was the nature of the market. The market went through a growth phase, And what's happened in the last 3-4 years, markets have gone, value funds have done much better as compared to growth oriented funds. If that's the reason, then I'm okay to hang on, because the whole purpose of investment is to diversify. There'll be periods where something does well, something doesn't do well. But let's say I am in a value fund, and in the last 3 years that value fund has also not done well. Then I have to be worried about it. Then I try and get into the portfolio, see what's happened, do a little bit more work, maybe talk to a few experts and ask them for their views, and then obviously if I'm not happy, then I take out money. So time frame wise, 3 years. Number two wise, if something is not working because it's not supposed to work, that's fine. But if it should have worked, like I said, growth did very well in 16 to 20. If you were known as a growth fund manager, you didn't do well in that period, then I like to understand what happened in that time.
So if somebody is evaluating fund performance.
And lastly, of course, is reputational issues. Something which is reputational, something has gone wrong in the fund house, then I think it's something that you need to be a bit, at least it's your money, so you better find out what's happened and then take a decision after that.
So what I was asking was, if fund is underperforming,
Right.
what is the right criteria to match it? Should it be the benchmark or peers?
A mix of both.
mix of
Bharti,
both.
yeah, yeah. It has to be. The benchmark is the easiest because the regulator is very clear as to what benchmark you should have, right? Number one. Number two, I think there are a lot of interesting ratios which are available in the fact sheet, right? For example, there is the standard deviation, there's a beta ratio, various 2-3 things which I don't want, it's a little complicated, but we can talk separately about. If you look at those and you do a mix of match of that, and that's why sometimes it's very good to have a financial partner with you. Right, it's very nice for me to talk about all these things, but sometimes for layman investors, even for people in financial services, sometimes the language and the formulas can get a bit daunting. Remember what I said, Bharti, in the first part. I think the primary job is to invest, and the primary job is to save, which I think we all do very well. Second job is to invest. Now, if you can understand what you're investing in, super, and there's enough of information available for you to understand. If you can't, don't let the fact that it's complicated stop you from investing. So if you understand those ratios, understand beta, you understand Sharpe, there are a lot of these nice things, and there are a lot of lovely articles written, so I'm not going into that. I think you Google it up, you will figure it out. But it's quite simple. And if you can do that, then manage.
What is the role of debt fund here?
Oh, debt fund is like a big shock absorber. So essentially, it's typically in the past, you have to have a mix of money in various asset classes, right? And I use my dad as a good example of it, right? I think he did a smart thing. He saved a lot, he invested a lot, and he's got some pockets of money in equity. He's got pockets of money in debt, which includes fixed deposits, by the way, of banks, which are very good instruments. He's got pockets of money in gold, and obviously he's got his real estate, and he gets some rental income from that. So at any one point of time, he's not over dependent on one asset class, right? And I think that's what debt does to you. Now, most investors don't do all this, right? They basically look at two things. Just like, yeah, मैं equity में डालता हूँ, मैं debt में डालता हूँ. Debt could be any format. Could be your public provident fund, could be your employee provident fund, could be bank FDs, could be company FDs, could be debt mutual funds, very big, lovely category. And each one have their positives and negatives, right? Like for debt mutual funds, people say, what is a positive? I said, yeah, until you take out money, you don't pay any income tax on it. Unlike any other, say, interest, like say you put money in a bank FD, after 1 year when it matures, you have to pay interest. You may renew the FD, but you will pay it again. So here there's no problem. Your money sort of compounds better without that. But debt is a great shock absorber. So funds which hybrid funds is nothing but a mixture of debt and equity. And some hybrid funds like multi-asset funds have a bit of commodities like gold, silver and all that too in that. So the more you do it, the better are your chances of getting a more more stable investment return.
So it's easy to say that it provides stability to your portfolio.
Absolutely, yes. So it's like this huge shock absorber in your portfolio, right?
This one question my friend asked: at what stage should you increase the concentration of debt funds in your portfolio? So, let's say. So
I don't think many investors have debt in their portfolio, Bhartinder. That's at least what the statistics say. Most of the debt funds in India are owned by corporates or really large investors. I think individual investors own more in equity than in debt actually. And I wish it was a mix of both, because I think corporates also have long-term money which they can put to work by using equity, and vice versa. Investors do have short-term needs which they can use, which can be fulfilled by putting debt funds. So I think the key thing in a debt fund is that as long as you're earning an income and your ability to take risk is there, obviously you can have lesser money in debt. Because even if something happens to equity markets, you are earning money, right? So you sort of able to cover up that loss. But as your earning potential goes down, let's say someone getting towards retirement or in retirement phase, obviously that's the time when you should sort of move up or concentrate more on debt funds at that point of time.
There are a couple of other category of funds that they have done really well. One is international funds, sectoral funds. So where do they fit in somebody's portfolio?
International is a great thing because Indians suffer from, like every investor suffers from something called home bias, right? So we are actually in step 1 of our journey. We have just kind of convinced people to go from traditional to capital market instruments. So we are in that step. Ideally, so most people are maybe upwards of 90% of their money concentrated in India. International funds give you that diversification, both by country, by industry. Like let's say if you want to buy a great EV business, you don't have a Tesla in India, for example. You don't have a BYD in India listed, right? Now you want to go and buy a Chinese stock market, you could get some BYD. That's what I mean by diversification. It has its own challenges because the more you invest in other countries, you have to understand those markets. They are subject to their own peculiarities, their own political systems, their own economic systems, their own reporting systems. So it's different. But a little bit of money has to be put outside. My view is that anytime, because all of us have some international needs, right? I think today a lot of parents want to send their children abroad for education. So that's an immediate need. And if you have some money internationally, at least it hedges you out a bit. Thematic funds or sectoral funds are meant for really evolved investors, in my view. I don't think the regular investor, the day-to-day investor should really get into that. Much not, because they look great in hindsight, but many times they just go through these huge cycles. And God forbid, if you're not in the right cycle, you're stuck. Because as per regulation, if you are in a sector fund, the fund manager, even if he doesn't like the sector, has to put money only in that sector. Right? But for evolved investors, people who understand sectors, like I know many people who believe that many sectors are undervalued and they should put money, by all means go there. But don't invest in sectoral funds just by looking at the previous performance. I saw a lot of people putting money into sectoral funds after COVID happened, and about a year later, most pharma funds were doing very, very well, right? And obviously their returns were much better than broad market returns, and a lot of money went there. But that may have been the end of the story, because the next 1 year returns are not that great. If you don't understand that sector and you're not an expert on when to get out rather than when to get in, don't get in at all. Then put it in a diversified equity fund and be happy with it. Let the fund manager, or if it's an index fund, let the index provider decide how much of a particular sector has to get it.
That's the problem actually. People look at performance and they decide to...
Yeah, and sector funds actually go through these periods of extreme outperformance or extreme underperformance.
And at that point in time, somebody is looking at it, they want to enter.
It's actually a bit frightening. So sector funds, that's why are, in my opinion, the highest risk in equity funds, because you're really narrowing your money down to one sector. So if you understand that sector really well, let's say, Parthinder, you are an expert on tech, and you understand those 20-30 companies very, very well, then please by all means go and do it. But if your reason to invest is, hey, last 1 year I got the return of that XYZ fund is whatever, super high, and I want to get in, maybe not that may not be the right thing to do here.
So past performance specifically is obviously not the right criteria to select the fund.
Absolutely.
Right? So
definitely not in sector. Maybe in other funds, yes, but definitely not in sector.
So I want to draw a parallel analogy to insurance, and one of the key parameters that you look at while buying insurance is claim settlement ratio, right?
Yeah.
So similarly, if somebody has to look at mutual funds, what are those 2-3 things that you should look at and say, okay, fine, both funds are doing well, I have to pick one fund. What is the criteria?
One is obviously outperformance to the index.
So benchmark should be compared.
Easy one, right? But if someone's really doing well, one also needs to go in and figure out what kind of risk they took, right? And that risk comes out. In fact, now our regulators come out with a new ratio called the information ratio,
Mm-hmm.
which essentially tells you how much risk a particular portfolio manager has taken to give you that higher return,
Mm-hmm.
right?
Mm-hmm.
So these are two things that one should look at. And obviously one should also be on the type of the, if you know, everybody is very happy. We have to put our investment policies on our website,
Mm-hmm. Mm-hmm.
right? So I think if you do a little bit of personal reading and find out how the fund manager is thinking about when he's investing your money,
Mm-hmm.
and get a little bit of insight in that, it will really help. So at 360 ONE, we have this interesting framework called SCDV framework,
Mm-hmm.
right? So it's basically very simple. We research a lot of companies. We put companies which have given 15% PAT growth
Mm-hmm.
and 15% return on equity growth. Those companies in 6 out of the last 10 years. So we're okay when in 1 or 2 years they don't give it. We call them secular. Companies which have done PAT growth but not ROE growth, we call them cyclical.
Okay.
Companies which have done ROE but not the PAT are called defensives. And companies which don't do both are called value traps.
Mm-hmm.
So that's the full form of SCDV. It's on our website. I mean, you
Mm.
go there and see it. It's something that our CIO Anup Maheshwari has devised,
Mm-hmm.
and it's a pretty easy framework to sort of for any investor to do, right from the most complicated, largest investor right down to a 1,000 rupee investor can understand it, right? So our focus fund, for example, looks more at the 360 focus fund, uses this framework, right? And that's one way of seeing. You got the benchmark return, you got track record, obviously, which is easy, and this is the type how they do it. So the how is in the investment document, which many people don't read, Bhartinder, which they should, in my opinion, and the what of it, which is the result, comes out in the return.
Mm-hmm.
I think most investors just focus on the what, like, hey bosses, what did this fund do in the last 1 year, 3 years, etc., etc. That's the outcome. You can spend a little bit of time and figure out how did they do it. I think it will make some sense. And if you can't do that, then partner with somebody and get them to do it with you. Yeah.
Would it be okay to say that fund manager is also one of the criteria to select funds?
Yeah. So Bhartinder, I think, like you said, I think the fund manager is an important part of obviously that decision on whether to invest or not invest. But I think the regulator is very clear. You have to have an investment framework, and that framework cannot be that, hey, Raghav Iyengar is the fund manager and he's the framework. He's part of the framework. Obviously, the execution is done, but there has to be a framework. There has to be a study as to what he's doing and how they are doing it, and that's all part of the investment policy. I mean, if you go, every mutual fund scheme has an investment section on how the fund manager or how the company or how the investment team is going to actually think of managing your money.
Mm-hmm.
It's not very long also, by the way. It's just about maybe 2-3 paras. And if the regulator wants and they feel it's a little complicated, they make us actually give examples about it. So it's not only complete English, which is very, very hi-fi for a layman investor. They've tried to simplify it as much as you can. The challenge in our business, unfortunately, is that everyone focuses on the what of the scheme or the fund or the category, which is that what is the return. Very few people focus on the how. And that's where I think if that's complicated, maybe you should just sort of get yourself a financial partner and sort of ease it out for yourself. Yeah.
So Raghav, most categories of fund are existing already. So is there a role of NFO for an existing investor? Who should consider NFO basically?
See, I think one is that there are very clear and stringent criteria that are laid down to launch a scheme, right? You can't have the same type of scheme in a different nomenclature. You can't have more of the same, right? And I think that's something that the regulator did very beautifully about 4 or 5 years back. I don't remember but they just cut the number of categories. So if there is a category, let's say flexi cap category, there can only be one scheme of any mutual fund in that particular category, right? So I think NFOs are interesting if they are coming from people who are not in that category. Then you will have to just get in and see, hey, what new stuff is this guy bringing to the table, or what is the thought process for launching a new fund in an existing category. There are lots of places where there are gaps in many fund portfolios, and they will launch when they have to launch, right? And so that's the first part. So that's easy to do. because the category is, let's say, if it's a mid-cap fund and there's a new mid-cap fund in the market, find out what it's going to do extra. If you like that, then obviously put some money. The second part is, I think, thematics, right? And thematics are interesting because thematics are not exactly sectoral funds, but they are based on a theme. So the last, say, 3-4 years, there's been a lot of funds around business cycle. There's been a lot of funds around the manufacturing theme. 2024 saw a lot of funds around consumption. So these are slightly broader schemes compared to sectoral, but again, from a risk reward perspective, they are more concentrated. So again, if you understand that theme, or you are of view that as an investor, you think that India is going to get to a great state of manufacturing in the next 5-10 years, and hence I'd like to be in a scheme which is focusing its investments on manufacturing, then maybe that's the fund for you. But a lot of what these funds do, diversified equity funds do too, with much more flexibility. Because sometimes, even themes go up and down, right? And if you are, again, it's the same problem like I said about sectoral. If you're in a sectoral fund and God forbid that sector is not doing well, your investment is not going to do well. If you're in a diversified equity fund, the fund manager has the ability to take money out of that and put it into another sector. Same problem happens in a theme, right? So if someone in a consumption theme, for example, and manufacturing really starts doing well, the consumption fund manager can't take all the money out of consumption and put it into manufacturing. He's has to stay focused on consumption. So he may not give you the best output. So that's the broad guideline. But
so there is merit in NFOs.
There is, provided you understand it and obviously understand what's the difference. And number two, if it's thematic or something different, obviously study it a little more and then figure out if it makes sense in your equity portfolio.
Most of the distributors and financial advisors typically restrict to multi-caps, index funds, and probably to mid-caps. While we have covered in some form or the other, but what is then? What are the investors for whom thematic funds, quant funds, ESG type of funds are the right funds? I mean, what is the role of quant fund then?
No, so quant fund is again a bit of a formula-based fund. So you have a mix of active and passive put into a quant strategy. ESG is interesting because there's a lot of, in the Western world, there's a lot of popularity around these products because, hey, are these companies polluting the environment? Are they doing good to the society? And there are indexes to measure it. So I am a person, for example, I'm a big believer in ESG. Hasn't done greatly for me in the last 5-7 years, especially post-COVID, but it's okay. It's a theme I like personally because I'd like to give money to people or to companies who are doing well. And by the way, again, the regulator is really pushing the pedal here. So if you see any large company or any decent sized company, there will be a fair amount of material on what the company is doing for the environment, their energy consumption, their substitution of plastics, all the other things which are very, very important to the planet, right? How much of renewables are they using, etc. It's not, as I said, greatly popular today, Bhartendra, because as I said, we are in our stage 1 of journey, which is moving from traditional to capital market instruments, whereas obviously many of these themes come from the West, where there's been 100-year plus of investment experience. So there you have a much more nuanced investor who understands that, hey, I want this type of a theme. In India, maybe that's not yet the case, but nothing wrong in having that. It's a very interesting idea.
Let me ask it in a different way. What I'm really trying to understand is that, somebody like me, 50,000, 60,000, say retail investor, there is a limit to the amount of discretionary income they have in a month,
absolutely,
right? So 50,000, 1 lakh,
whatever,
1.5 lakh, whatever, right? There is a limit. It's not unlimited, right? Now, if you look at the average ticket size of SIV, still under 10,000 rupees.
Yes, absolutely.
Yeah, right? So it's safe to say that people have 30,000, 40,000 funds to deploy in a month, right? In that, if somebody has that kind of money to deploy, what are the first 2-3 categories you should consider?
I think FlexiCap is right on top, Bhartendra, because I think FlexiCap from an active manager's point of view is a great category. It has its drawbacks because once they get very large, then they tend to be more large cap oriented. And I'm talking large as in fund size of 20-25,000 crore types, right? So that's what I've noticed in past behavior. But FlexiCap is an easy category. A large cap is an absolutely easy category. Multi-asset is a superb category. They must get into multi-asset because in one 10,000 rupee instrument you get everything. You get equity, debt, gold, silver, and new categories are coming in, InvITs, REITs, international equities. You can buy all this for one check, right? If you were to try and buy it separately, you will have to cut 10 different checks, right? So these are two of my favorite categories. I mean, flexi and multi-asset.
Multi-assets, flexi cap and large cap.
Large cap is fine. I mean, if you're, again, it depends on your time horizon. So if you tell me, no, I've got less time horizon, but I want to put money in equity, a large cap is a safer place to put money today because those are large established companies with very good business models. The chance of a large cap company becoming zero are, in that sense,
so equity but safer.
If there is a word like that. There is nothing like safe equity, by the way. Let's be clear about that. Yeah.
Okay. So Raghav, you've spent so much time in the industry, so you're the right person to ask this question. Is there anything that you would want to correct in the mutual fund industry?
I wish there were more distributors in the industry. For the number of investors that I think this industry can manage, I think we need more distributors and we need more investors. I mean, somebody sent me an interesting note the other day saying that the mutual fund industry has about 5.3 crore investors, individual investors. There are about 20 crore folios, but essentially 5.3 crore investors, right? And I don't know which is that recent thing, the Bitcoin exchange, I forget which one, CoinDCX or one of those. I think they got some 10 crore investors within a year of launch, or 10 crore subscribers or whatever. So I think we have a long way to go in terms of, that's something that I think the industry can do much better. And how can we get more investors to come in? I think there's a lot of work happening, and what the Association of Mutual Funds of India is doing, AMFI is doing, is great, because I think there's a lot of promotion that's happening. Mutual funds, I think there's a lot of regulatory attention being given to this, especially trying to ease off the process of onboarding a new investor. So those are all happening. But I wish there was something, I wish I could think of a magic mantra by which I could recite and this 5 crore investors becomes 50 crores. Yeah.
So what is one piece of conventional investment wisdom that you believe is the most dangerous for the investor today, that is being circulated, like it's advice is free on internet?
Actually, there are many, but yeah, the one that I'm most worried about is that markets can never fall. And I think especially recent investors, and I mean investors who have come, say, post 2020 or maybe post. So if you see, the number of investors have had two big jumps in the industry. One happened during the Demon incident, right, where I think there was a big move of money from traditional to mutual funds specifically. And one was recently, of course, after post-COVID, the whole digitization of the entire, or rather digitization, financialization. I think most investors have this, because public memory is short, most people just tend to relate it to the last 3 years, 5 years. Nobody goes back and sees 15, 20, 30 years and sees that. And that's something that I have by benefit of my experience. That there have been periods, Parthendra, where equity has given negative returns for long periods of time. There have been long periods of time where there have been zero returns in equity. And I think that's the one that worries me the most, that most investors who are coming in with this thing that, hey, I'm definitely going to make money. And I pray and hope they are right and I am wrong, because obviously all of us want to see an investor making money, right? It gives me no pleasure in being right in this, but I think they must understand that there is a possibility that there could be a loss, or they could see some fall in their capital value, at least in the short term. And I think that's the one that stresses me out the most today.
That's where the
number two, which worries me also, it's much better today compared to when I started life. And in fact, I'd say it's a life lesson for me, because a lot of my initial investments were done by pure word of mouth. Somebody told me, I met someone, and I considered themselves to be much more smarter than me, and they said, yaar, ye 4-5 cheez stock mein dal do, right? And there was no research, there was no thought process, there was no goal definition, there was no downside thought process that, hey, if I put this money and it vanishes, what happens? No things like that. I think that's gone down a lot today. And at least if, I don't know if you saw the last couple of weeks, regulator has been asking questions about fin-influencers, right? And especially who are promoting things, right? And I think that's something that I wish people don't do too much. When they start investing, it's hard-earned money, boss. It's not It's not something which is fallen from the sky, right? And then you are very casual about investing it.
Mm-hmm.
So I see two types of investors now. People who are overly researching.
Mm-hmm.
They're only researching. They are watching all the videos, they are watching all the television, they are reading all the articles, but they are not investing. And I have this other set of investors who don't do zero research or who are very trust oriented. Like, nahi, no, sir ne bola hai to sahi rahega. And they will go and dump money into it. Right? I think the way to do this is somewhere be in the middle. And always remember it is your money. Right? So you have to take care of it. Right? And for that it needs a little bit of hard work. Thoda ek aadh ghanta TV kam dekho, maybe.
This is where the distributor and advisor also come in play.
Absolutely, yes. They help you a lot, especially running through your emotions. Because I think investing is also about IQ and EQ, right? Let's say IQ, everyone gets the amount of work you do, the research you do. That's based on how much you understand it. But EQ is much more difficult. And sometimes it's better to have a partner to help you do that. Yeah.
You are from mutual fund industry, but is it okay if I ask you, if you were to build the portfolio from scratch, what are some of the non-traditional asset classes that you would consider?
I think I would do some work in private equity,
Mm-hmm.
or what I call in today's world alternate assets.
Mm-hmm.
Because I think I think especially the phase of growth that India is in today,
Mm-hmm.
we are not a developed country.
Mm-hmm.
We are getting towards a developed country. We have 20, 30, 40, 50 years to go to be hopefully a developed country. And hence a lot of investment opportunities are coming, which may be in the unlisted space,
Mm-hmm.
both in fixed income as well as in equity
Mm-hmm.
or even in real assets.
Mm-hmm.
And I think I would have put a little bit of my money in that. Number two, I would have put some more money in maybe international asset classes, you know, especially really large markets like the US, for example. I mean, the international funds have been maybe a decade old, maybe a little longer than that, but maybe these were the two things I would have tried and somewhere inserted into my portfolio. Yes.
Alternate asset and international.
Yeah. So alternate assets, I am changing a bit. So I am the last couple of months I have been putting some money
Mm-hmm.
to work there. International, fortunately, I have some.
Mm-hmm.
So that way I'm a little bit covered. But for younger investors or people who are maybe in the middle of their investment journey, maybe they should think of both these asset classes.
So you must be investing for what, last 20, 30 years?
Yeah, almost 30 years. Almost
30
practically
years.
30 years. Yeah.
Is there anything that did not work for you? Your investment failed.
Oh, I have a whole stock of horrible companies that I put money in. They're all in paper format. I think they don't exist anymore.
Mm-hmm.
Many of them are gone.
Mm-hmm.
So my value of investment is actually just zero, exactly zero.
Mm-hmm.
And every time I get a little arrogant and I feel I've done too well for myself, I look at that piece of paper.
So how has your approach changed towards investing from those failures or those bad investments?
I'm happy to put money, I'm happy to give my money to professional fund managers today. I was very reluctant maybe 25, 30 years back. I was possibly young, foolish. I am a chartered accountant, so I thought I'm a CA, that gives me an automatic right to be a great investor. I don't think that's correct. You could be a great chartered accountant, but you may not be a great investor. So what I realized was that I'm very bad at, and most investors are, by the way, not only me, are very bad at cutting losses.
Mm-hmm.
So we're very happy to, cut profits.
Mm-hmm.
So something doubles, we say, usko nikal do.
Mm-hmm.
Book profit, that's the new terminology. But nobody books losses because it's very difficult emotionally to do. That, I bought something at $100, it's now $50. I don't have the strength to cut and make a loss of 50 rupees. So you keep looking at it every day, praying that, hey, let this thing go to 100 and then I'll get out. I think that's where sometimes a professional fund manager helps, because they are emotionally detached from that investment. And they also know that they can't get 10 on 10. I hope they do, but many of them don't. But I think as long as they have more wins than losses, that's fine.
And a professional fund manager comes with the fund, mutual fund. So mutual fund is the way
it's
to
one
go?
way, yeah. Not mutual funds, alternate investment funds, PMS, all of them have managers. Yeah. Most importantly, regulated managers. See, everyone's a manager.
Mm-hmm.
I mean, this room could have 5 managers here. But a regulated manager, somebody who works under a set of regulations, who's subject to some scrutiny, those are the people I like to give money to. It's hard-earned money. It's like, there's so many car manufacturers out there, right? Would you give your money to a renowned car manufacturer or somebody who builds a car in a garage? Car is the same, right? But because you're giving it to a renowned guy, you're okay about quality, you know that it's been built under certain standards. Same logic applies here.
So the next question is, it's like so many times I've observed people go to office, open their laptop, maybe market has fallen 1%, 2%, the portfolio has gone down by few lakhs, few thousands, and they panic and they discuss market gir raha, market gir raha. So what is your mental model to look at market volatility?
I switch it off. I don't put the TV on.
So what would you say to people who look at the portfolio every day and look at the market?
Don't. Then you do two things, Bhartinder. Either you quit your job and you become a full-time professional money manager. You say, hey, this is what I'm going to do 10 hours a day and I'll do it well. And trust me, investments, though looks complicated, it is not very complicated. If you get your basics right, you will be okay. Right? It's a lot about emotion. As I said, there's a lot of knowledge out there. So one does not, obviously one needs a certain bit of training, and obviously some of the best fund managers I know, a few of them where I work, are emotionally very stable people, right? So I think that's very critical. So either you do that, or you switch off your TV, or just switch off from your noise and do your work. I mean, like you rightly said, everyone's got 30, 40, 50, 60,000 rupees of investment surplus to invest. I would rather focus on trying to make that 50,000 into 1 lakh and have more money to invest, rather than figuring out that how do I optimize that 50,000. And if you think you're very good at optimizing that 50,000, then you should not be working. Then spend your time optimizing that or making that portfolio really a rocket portfolio.
So Raghav, last two questions.
Oh, okay.
First one, you have managed some of the large fund houses. You worked with ICICI Prudential, you worked with Axis,
Yep.
And now you're working relatively a boutique firm,
Yep.
So what is the difference? And you could answer it in two ways. One is as a professional managing these fund houses, and secondly, how should investor view this? Generally people go with larger fund houses, but I'm sure smaller fund houses also have some good funds to look at.
Yeah, so I think the reason I chose 360 ONE after my earlier stint was, I think they have a solid investment framework, right? So obviously it's people, process. So those really both ticked off. And many people don't know this, but 360 ONE manages a huge amount of institutional offshore money. So we have some of the largest investors in the world entrusting us with their money. It doesn't come into the mutual fund AUM, it comes separately, which is why possibly it's not seen. So that gives you great confidence that when some of the largest investors in the world are actually giving their India portfolio, part of their India portfolio for you to manage, because that's what you really need, right? We are just selling an investment process. And number two, 360 ONE is a very aspirational brand. It's again, we are the largest wealth manager in the country. I mean, our assets under management, what we advise and what we take care of is more than 5 lakh crores. And it's a relatively young company. It's 15 years old, 15, 16 years old, right? So I think that combination is what got me going very, very quickly here. I think 360 ONE has a very, very prominent alternates business, investment business, right? In 3 or 4 product lines. Most people struggle to get one right. I think we've got 3 or 4 right there, right? And reasonably large sums, pools of money we manage on behalf of investors. So this combination, you have a great listed business, you have a great unlisted business, you have a young company, and obviously a good thing about being in a young company is speed and experimentation are very high up on the list. So I think it's a great brand to take forward here. And I think the more importantly, the investor in India is now used to seeing new brands. Obviously there is a familiarity advantage, like most people are unfamiliar with 360 ONE, right? In my own family, many people didn't know what was 360 ONE. But once you explain it to them, tell them what our shareholding looks like, what we do, I think the ability for me to then get some investment from them is much, much easier. And Indian investors are happy to look at newer brands. That was my revelation. So it's obviously they will put money to familiar brands, but if you come to them with an interesting investment proposition, even if it's from a company they have not heard in the past, they are happy to listen to you and maybe make an investment with you.
The investors should look at all the fund houses, all the options, not just bigger brands.
Of course.
So last question, Raghav, to the young set of audience who's starting their jobs today and who are going to start, what is the one piece of advice that you want to give to them with respect to financial, managing their money?
No, I think one is you have to save, figure out how much you want to save and start upfront with it. So if you're making 100K a month, post-tax, I mean, and you have the ability to save, try and save 30% out of it. right? Because from where I started, there used to be a lot of forced saving. There used to be compulsory provident fund and then ATC benefits, etc., etc. Today, those are not there. I mean, it's there, but it's a choice. I mean, if the investor wants, I mean, you can take. If you don't want, don't take. So in that sense, that forced part is gone. So you have to be voluntarily saving, right? Number two, remember that your savings are the only thing that takes care of you in the long term. So the faster you start, the better it is. So get going, try to put as much money as you can, and in the first 10-15 years of your life, try and tighten your belt a bit. I think most people who start their job journeys just open up, and they're very, very, very different people in college. Everyone's very frugal, they have to live on a budget, and suddenly they get their first salary check or their first gig or whatever gives them income, and suddenly all those restrictions are gone. I think some restrictions should be there. In my case, I can tell you, I was reasonably restricted personally, my wife and I, till I was about 45 years old. We were pretty careful about what we did, and then once we hit a certain number, which we had aspired to hit about 15 years earlier, we said, okay, now we can get a bit more relaxed out of it, because then you're fine. But if you had done that, and that took some learning, because the first 5 years of our marriage, we were very unrestricted. So we used to do all kinds of things, and then we realized, hey, we've spent 5 years, we've saved nothing practically, right? And then because of financial markets went through some convulsions, and then we realized, yeah, I don't even have any emergency money. Right? And that's when it sort of hit us that, hey boss, we better start doing something. And then the next 15 odd years, we really sort of 10-15 years, we really, I didn't tighten up, but we were careful. And then after that, once we hit a particular number, we got a bit more comfortable with our liabilities. We sort of let it go.
To be comfortable, hit a number.
Yeah, so plan it, but plan it today. Don't waste 5 years like I did and then realize, oops, I don't have anything, and then start panicking. Like I said in the beginning of the show, the best day to invest was yesterday, the next best day is today. So get going, sit down, do whatever analysis you want. It's very easy to set up an investment plan today. Try and tighten up. If you get $100, try and save $30-35 out of it. I know it's difficult in a city like Bombay or in any of our larger cities where expenses are very high, but you have to manage. Have 5 cups less of Starbucks coffee if you have to, save that $1,000, right? Make some sacrifice. It just pays off. You will suddenly realize 10, 20, 30 years later, what a big difference it's made to your life.
Thank you, Raghav.
Thank you, Bhartinder.
The session was very insightful.
Thank you.
We're not done, we'll do a round 2.
Yes, look forward to that. Yes.
Thank you.
Thank you.